Ron, Jeff, there have already been a number of equity offerings this spring that have been quite large, but most analysts seem to think that it'll take multiple offerings for REITs to kind of recapitalize their balance sheets and also to take advantage of opportunities. Do you think that the market can sustain this?
I think there will be a lot more capital raised. I think, the tension you always have in the room when you speak to a company is that they don't think they need as much capital as the market may think they need. And I think right now they've raised a correct amount for them to weather the storm over the next few years. I think if we see opportunities arise, I think a tremendous amount of capital will be raised. I think if certain assumptions are not met in terms of refinancings that we projected within the context of these offerings, again, additional money will be raised. I do think this is a multi-phase process, and you will see these companies access the market multiple times over the coming years.
If the fundamentals go down to Jeff's point where we've assumed they've gone, I don't think a lot of these companies will need to go back to the equity markets unless they see opportunities. If, on the other hand, they can't refinance roughly 60%, if the fundamentals continue to drop off, if they can't sell the assets they'd hoped they'd planned on selling, they're going to have to come back to the markets just once again to fix the balance sheet. And then again, if they fix their balance sheet, then when they see these opportunities, they just don't have any free capital to go out and pursue what we think may be one of the best buying opportunities we've probably seen since 93, 94, 95. We expect those out, hopefully not in the too distant future, but out in the future. They're going to have to come back and raise a lot of equity to pursue that. And this time, they'll pursue those without nearly as much leverage.
What's your take on the outlook for mergers and acquisitions going forward?
I think that there'll be some. I don't think it's going to be a great amount in the near term in terms of company to company. I think that most real estate companies don't like to sell when they think they're at the bottom of something as opposed to the top. And an acquirer generally doesn't want to take on a balance sheet that would in any way make his look more negative or hers look more negative. I do think from an M&A perspective, you will see a tremendous amount of assets over the coming years come from the private markets. And the private market assets will be gravitating towards the public markets, as I believe the public markets will value real estate and the platform more valuably than the private markets will. And that will be a large source of growth capital or growth assets for our business.
And how do you see things shaping up in the debt markets?
First, clearly there's very little bank debt available today. And if you look at the way the real estate companies, the NAREIT participants finance themselves, it was bank debt, CMBS debt, and bonds, typically high grade or high yield. There is no CMBS debt for all the reasons we know. There is some bond business again. I mean, obviously Simon and some of the hotel companies have actually gone out and raised some new longer-term bonds, which is fabulous because it's pushing the tenor out longer term. So if they have something coming due in 1 or 2 years, they've been able to push it out 5 to 6 to 7 years out. That's very helpful, but it's still a trickle. And then the bank debt market is generally closed for new deals. But the banks are refinancing all of their existing loans. Very little foreclosure that we've seen out there. There have been almost, I don't want to say universal because you'll always find a deal that did get a foreclosure, but most of the time the banks are doing their best to accommodate clients by extending, taking a little more collateral. And if you look at the corporate revolvers, we have been amending them, extending them, charging a little more, but giving the REITs longer time frame upon which to raise some equity, as we talked about before, and re-equitize and recapitalize the balance sheet. This debt market, I think, though, will be generally limited for at least another 12 to 15 to 18 months, which goes back to driving Jeff's point about M&A. You're going to have to do M&A with just a lot more equity, which means if you got more equity with less debt and you want the same return, means the prices will continue to fall for some period of time.
Ron, Jeff, thank you very much for your time. For more information on this and other REIT news and analysis, check out REIT.com.